Good morning, everyone. Welcome to today's webinar. We're thrilled to have you all join us for today's Australian Economic Update and Federal Budget Overview. For those of you that are unfamiliar with me and haven't met me before, my name's Graham Beattie. I'm one of the principals of the Worrells, New South Wales and ACT offices. I've got Brendan Giles here with me to my left as well. Today we're fortunate enough to have senior economist Harry Ottley from the Commonwealth Bank of Australia join us to present on key economic indicators that will impact your future. Over the next hour or so, Harry will offer insightful analysis on a range of topics critical to understanding the Australian economy. Harry's going to cover things like current inflation, the labour market, Australia's economic growth trajectory, interest rate movements, and federal budget implications. So throughout the session, we'll also be running some polls to gauge your thoughts and opinions on some of the topics. So please participate in those as Harry presents. I'm sure Harry will also do his best to answer all your questions during the Q&A session. However, if time does run short, please bear with us. If we can't get to you, we will get answers to your questions out in the follow-up to the session. So without further ado, I'll hand over to Harry, and please give Harry a warm welcome to today's session. Thanks, Harry.
Yeah, thank you very much. So to your point, if anyone has any questions, burning questions throughout or questions that are popping up after the session, my email's up there. I'm always happy to respond to anyone's email that has any questions about sort of our view or what we're talking about. So today I'll go through first some of the high level budget outcomes from Tuesday, some of the key policies, I suppose, and the trajectory of the budget, and then also go through our broader view on the economy here at CBA. So yeah, I'm Harry. I'm an I'm an economist within the Australian economics team at CBA. So we have remit for the entire Australia economy, including the RBA call. So I'll get started. If we take a look at the budget, I think there's a few key takeaways. Number one is the good news. There was a surplus in 23-24. Well, that is expected, and that's expected to be $9.3 billion, and that'll be the second surplus in a row. Looking more forward, it was more expansionary than we had expected, and I think most people had expected. It contained a lot more spending than many people anticipated, and that resulted in budget deficits in the out years. So this year, $9.3 billion surplus, and then swinging back to deficit for the coming financial year of $28.3 billion, $42.8 billion, $26.7 billion, and then $24 billion. So pretty decent deficits out in the out years. And it's the new policy decisions within the budget, i.e. more spending, that is really driving the deteriorating budget position, in addition to those tax cuts that are coming through as well that were already baked in. But there were some new policies from the last time we heard from the Treasurer in the MYEFO, the mid-year economic and fiscal update in December, and we did get some more spending announcements. So really importantly, the Treasury forecasts inflation to be 3.5% in the June quarter this year, and then 2.75% in the June quarter next year. So what that means is they think inflation will be back to target sort of by the end of this year or thereabouts. And one of the reasons is because those cost of living measures that I'll go into a little bit later are expected to detract around 0.5 percentage points from headline inflation. So our base case remains that the RBA will cut interest rates in November this year, but this budget has, kind of solidified the risk that we'd been talking about for a little bit within our team about, the potential that fiscal policy will become more stimulatory, and that's kind of crystallized that risk to us. So we remain with our base case of a cut in November. And I'll go a lot more into our call a bit later, but we kept the base case there, but just flagged there is some risks. So having a look at the headline numbers, you can see there in the first chart, spending as a share of the economy spiked during COVID, obviously, has come down to a point now where we've got a couple surpluses, and then really springs back up, especially in the upcoming 2 financial years, whereas revenue now really sort of comes down to a more to a level around 25% of GDP. The big reason behind this, as I mentioned, is those really big stage 3 tax cuts, which have since been rejigged to spread more of the tax relief down the income quartiles. But yeah, you can see there that's essentially why we have deficits. We have spending up and revenue down. And then the second chart there is just showing, those deficits out into the out years. Not quite as big as they were during the post-GFC era, but still some pretty chunky surpluses in there. So looking at, what's changed since the budget last year. So this is going back 12 months or so. You can see they forecasted a deficit of more than 30 billion for this coming financial year. And those bars following that first bar there is kind of explaining what's changed since then. So we had a really big increase in economic parameters. That just basically means the economy's been a lot stronger than they expected. So, their taxes are higher and their revenues are lower than they expected. And their the third chart there, the third column there, sorry, is new policy measures, for the coming financial year are quite a lot. But compared to the budget last year, we're still actually forecasting a smaller deficit just based on those, better economic parameters. The second chart there shows the differences over the out years. So you can see in blue there, that's parameter changes. Again, that's broadly reflecting increased economic activity, less unemployment than what they were expecting 12 months ago, and therefore, their budget position is quite a lot bigger. But it's the red bars down the bottom there, which represents the big increases in spending that they've decided to put into the economy. And you can see they're really front-loaded towards the 24-25 and 25-26 financial years. So a lot more spending than we were expecting, I suppose, and probably a more expansionary budget than we're expecting overall. A little bit of context though, we are starting from quite a good position. If we look at that first chart there, that's the budget balance for a few of our peer economies in 2023. You can see Australia there in a small surplus, and you can see the US there just running enormous budget deficits at the moment, providing heaps of spending into the economy. And inflation has proved sticky there, but has still come down quite a lot. And then you've got the UK and Canada also running pretty big budget deficits. You can see that line there I've got with the 25-26. So that's what our deficit is forecast to be at the peak over the 8 years at 1.5% of GDP. That's in 25-26. And you can see there it is, still not nearly as big as what some other countries are running. And then if we look at the second chart there, that's government debt as a percentage of GDP. And you can see Australia, very low debt in comparison to some of our peer economies. And so we are starting from a slightly different point going back into those deficits. So a key point was the forecast, as I mentioned earlier. So this first chart here outlines the now quite big difference between Treasury and RBA forecasts. You can see the Treasury forecast for headline inflation there in blue, the blue dots, and the RBA is the triangles. And the reason for this difference, essentially, and the key difference really is that second blue dot in, this is Q2 next year when they're expecting headline inflation to be down to 2.75%. That's about a 0.5% percentage point difference to the RBA, who are expecting 3.2% by that time. And this really reflects the difference that will come from those policies aimed at cost of living in Australia to bring down inflation. And that's why, Treasury at the moment is a lot more optimistic than the RBA. Now, there's a lot of discussion around, whether putting more money into the economy will have a counter effect and actually increase underlying inflation. And I think that, broadly is a fair argument that they are stimulating the economy and they're mechanically bringing headline inflation down, but it might not have as a big impact, obviously, on underlying inflation. We think that's a fair argument. But we're kind of thinking that inflation will come down on its own, and we might see some positive results towards the end of the year on the inflation front. So we're probably more on the Treasury side in terms of headline inflation. We kind of expected they'd bring in these cost of living relief, so we had that baked into our forecasts. But that's really the key difference between, how the RBA is thinking about the economy at the moment and how the Treasury is thinking about the economy. The last time the RBA put out their forecast, they didn't have the benefit of these new policies. And so, yeah, Treasury, a lot more optimistic on the inflation front. They're clearly very interested in getting a rate rise this year. A rate cut this year. And they mechanically brought down that level of inflation. So the second chart there again just shows some sort of differences in the forecast. Again, broadly, if we look at the Q2 25 differences between Treasury and the RBA, not massive differences really. Just that a little bit stronger growth from Treasury and lower CPI, but broadly, they're expecting it to trend in the same direction. The Treasury is just with the benefit of those newer forecasts, including the cost of living policies, have inflation coming down a little bit quicker. So if we think about the high level budget strategy, what are they trying to do with this budget? Well, we think it comes in two pillars really. So the first pillar, and that's near-term focus, is the cost of living relief. So the tax cuts previously announced are quite large, but they were already baked in. That's not anything new. The new policies really was the rollover of the energy subsidies. The interesting thing there was they're not means tested. So they're going to all Australian households a subsidy of $300. So, that's also caused a lot of discussion, whether it should have been means tested. We were surprised it wasn't means tested, but reading between the lines, it kind of seems like it's quite a complex administrative task to means test the an energy subsidy based on income, and so they've just decided to throw it out there, and it is still a progressive form of relief because it does benefit lower income earners more because it's a bigger proportion of their income, but that was surprising to us that it wasn't means tested. We had rent assistance increased again, so 10% this year. It was 15% last year. That will also play a role in bringing down the measured inflation, as I mentioned. And then there was also, some other policies like cheaper medicines, among others, targeted at cost of living. But really, primarily, it was the energy subsidies and the Commonwealth rent assistance. So that's near-term focus. Their focus is on bringing down measured inflation, giving some relief to households out there. And then the second main pillar was a more forward-looking focus, and this is more around how the government considers, their long-term strategy, their strategic economic goals, and this came in the form of the $22.7 billion over 10 years Future Made in Australia policy. And it is a really broad, difficult to sort of explain and pin down exactly what each policy is trying to do. And it's basically just a range of tax incentives, removing red tape, subsidies aimed at industries that the government believes match Australia's strategic economic goals. So they've kind of broken it up into two streams. The first stream being, industries that will assist with the net zero transition, things like green hydrogen and green metals, focusing on that. And then also the second stream is based on Australia's economic security. And there the government's really worried about supply chains and concentrated manufacturing output overseas where Australia doesn't make the things that they think are important for our economic security, and that's things like refining critical minerals and the manufacture of solar panels, things like that. So that is the two pillars really. So cost of living relief in the near term, and then the longer term focus on trying to capitalize on some of Australia's comparative advantages with new and emerging industries that they think are critical to A, net zero, and then B, economic security. So from our point of view, it's kind of too early to tell, how effective this will be. It's quite an ambitious policy going ahead. I think from, an economics point of view, we would just hope that the government focuses on, where we really do have comparative advantage, focus on those industries. But there's, going to be a lot of money flowing to that policy in the coming years. So I'll leave it there on the budget. Overall, yeah, more expansionary than we expected, more spending, but cost of living relief was expected. People are struggling out there. A lot of people are struggling out there and need assistance. So the government stepped in. There's a chance it might be more inflationary than they're expecting. but there's also a chance, by the time that, the inflation from the stimulus that they put through the economy comes in, maybe some of the other idiosyncratic factors of the inflation basket that I'll go into later on, maybe, wash through a little bit and, it nets out. But that's the uncertainty clearly. Our view is that, the RBA will still be keen to cut rates, even despite this, more stimulatory budget than we expected. So happy to take questions on the budget at the end, but I'll move into, our view on the economy. The budget doesn't, necessarily frame this. This is still our view. The risk is, as I said, just that it is a bit more stimulatory than we expected. So key themes for 2024 in the Aussie economy is global inflation has fallen materially, and most central banks are set to cut rates this year. It's been a bit of a bumpy road, the last mile of inflation, which was always expected. But broadly, inflation has come down a long way and progress has been made. Households will remain under significant cost of living pressure this year, but there's some relief in sight, in part due to some of the measures in the budget. The Aussie economy has slowed quite a lot. Economic growth is sluggish and will remain below trend this year. Consumer spending is weak in a growth sense, and especially in per capita terms has been going backwards for a while now. The labour market, we think, will loosen further. We saw the unemployment rate tick up to 4.1% yesterday. We think that has further to run, and that means wages growth has likely peaked as well. And so, again, we think the RBA will cut rates from November this year to support the economy as inflation cools and the unemployment rate begins to rise. So global inflation, as I said, is easing. Again, it's been bumpy in some areas. You can see here in this first chart, we've aligned the peak in inflation from various countries, and that was to show that, Australia is broadly tracking in a similar way. We've kind of followed the US about 6 months behind this whole cycle. And what you can see there is really good progress on inflation, but a little bit of stickiness emerging in the last mile, which again was broadly expected by most people. The second chart there shows, how interest rates have risen in some of our peer economies as well, and the dashed lines there represent current market pricing for the path of the interest rate. So you can see the FOMC there, America, the Fed, two cuts priced in, similar in the BOE in England, and then the ECB, are expected to start cutting as early as next month. So most central banks, really starting to think about cutting now. Australia is not quite there yet. You can see we're a little bit of an outlier on that at the moment, and that's broadly due to, I think, we're a little bit behind the rest of the world in the cycle. We opened up a little bit later. But, we would expect market pricing to start reflecting cuts if inflation in the next quarter stays, is well behaved. So dialing into, our inflation story a little bit to try and, explain why we're getting a little bit more stickiness. So you can see here, it remains above target, but it is trending in the right direction. We've got, headline inflation at 3.6%. That's, about 0.6 percentage points above the target of 2 to 3%. So I think this chart shows, we've made a lot of progress. We had a bit of a rough print last time out in Q1 2024 of 0.1%. And you can see that on that second chart there, trimmed mean inflation. This is really what the RBA tends to focus on in terms of underlying inflation. You can see it's choppy on the way down, but it still is heading down. But that last print of 1%, did cause us to reevaluate our call a little bit and cause market pricing, which you can see on the previous page, level out in Australia. That's why it was an upside surprise, but we're expecting it to continue to ease. So looking at why is inflation still elevated? Well, if we look at the split, it's really essential inflation, essential goods and services, which is keeping inflation high. You can see in the first chart there, in maroon or red is non-discretionary inflation. It remains elevated and above target. Whereas you can see, that discretionary inflation in black is now back to target. So that's indicative of weak consumer spending, as I'll go into later. People, are feeling stretched, and so they pull back on their discretionary goods and services spending, and that's assisted to bring down that part of the basket. But it's just those essential goods and services which is providing, a bit of trouble for the RBA. And that second chart there is, some of the key parts of the basket that are proving sticky. So we've got insurance is the big one. It's really, really strong at the moment. It's not sustainable for insurance inflation to keep going up by this amount. We would expect that to ease. We've got rents there and then home building. So really big issues in the housing market, as I'll touch on. And that's keeping, rents and new build inflation elevated. So that's the reason why inflation remains elevated and a little bit sticky. It's that, essential goods and services. And, those are some of the examples there in the second chart. So we think inflation will continue to ease. It might be a bit bumpy, but look, if you look at the first chart there, the CPI excluding including housing and insurance and financial services, that leaves us back in target. And what that says to us is, well, unfortunately, we can't just strip those out and the RBA will cut rates. But it's kind of showing that, there are a few really troublesome parts of the basket, but a lot of the other parts of the basket are becoming more well-behaved. And we think there's a good chance that inflation will continue to ease because of this. Another reason we think this, there's a lot of indicators out there of inflation in the private sector. You can see the second chart there. Is a really good measure from the NAB business survey of final prices in blue, really closely matches trimmed mean inflation, and that continues to ease. Inflationary pressures are coming off, and we'd expect that to continue. So that's inflation covered. Well, what did the RBA do in response to inflation? Clearly, as we know, they increased interest rates quite quickly. You can see there, we raised rates from 0.1% up to 4.35%, where we are now. Much higher than pre-COVID, but a more normal level compared to the pre-COVID, to maybe the 2010s or pre that era where interest rates became very low. The second chart there is an interesting one. It kind of shows how our rate cycle compared to other countries, compared to the day after the first hike. So you can see in Australia there, we raised rates quite quickly. Overall, we were a bit later, as we know, but once they started, they got going. But then they slowed a bit more quickly and they leveled out at a level lower than many of our peer economies. And there's been a lot of discussion. People have very strong views on whether we raise rates enough. We were always of the view that we wouldn't have to raise rates as high as other central banks. We didn't think they'd have to raise rates as high as this, but we were wrong on that. But we were always confident we wouldn't need to, raise rates to the same level to get a similar result on inflation. And the reason for this is our variable rate mortgage market, which you've probably heard a lot about. In Australia, the majority of mortgages are written as variable rates. And what that means is when the RBA delivers an interest rate increase, households feel it straight away. So you can see in Australia, despite not raising interest rates as much, the flow through to outstanding mortgage rates is actually higher and much more quick than many other of our peer economies. So if we're on one end of the spectrum with almost entirely variable rate mortgages, the US is on the other end of the spectrum. So they have the majority of their mortgages written at 30-year fixed rates, which means when the FOMC, the Fed in the US, increases interest rates, households just don't feel it in the same way that Australian households do. And you can see in the second chart there, that's a big reason why we think the Australian and US economies have diverged so much. This is household consumption per capita. You can see in the US, it continues to rise quite strongly, whereas in Australia, it's been declining for some time now. So in addition to that, we also have, the increased tax take in Australia through the cycle. And what's caused that is, Australian, tax brackets are prone to bracket creep. They're not indexed to inflation. So when the economy is strong and the nominal economy is strong and people are in work and the labor market's good, we pay a lot more tax and we pay it a lot quickly. We pay a lot more quickly. And you can see that really rapid rise in the last few years. You can see we've got our estimate of the impact of tax take. The new tax cuts will make a bit of a difference, but not a massive difference. So the taxes that we're paying, the increased taxes that we've been paying, have also been a drag on real incomes. So what does that mean if we, zoom out and have a look at real household disposable income, more thoroughly? You can see here that in the black line, that's real household disposable income overall over the year. And you can see it's still negative. It got down to around -5%. And the reason for that is the issues that I've started this presentation with, right? So we've got inflation down the bottom in purple, really detracting from real incomes. We've got the income tax take decrease, contracting from real incomes. And then we've got in red there, the increased dwelling interest. So inflation is the big one, detracting from people's incomes. And that's why we have that cost of living issue out there. That's why people feel like they're going backwards. It's because the best measure that we have of real household disposable income, of living standards, it has been going backwards. And it's been going backwards by a lot more than other countries and a lot more than what is historically normal. So you can see in the first chart there, the real household disposable income contraction that we saw last year of minus 5.3% is the biggest that we've seen in history, based on this series going back to the 1960s. And you can also see in the second chart there, the impact on our real household disposable incomes per capita has been much more severe than many of our peer economies, again, especially the US at the other end of the spectrum. And, this really explains the divergence in the economic outcomes and should explain in part why inflation can come down here in Australia where it's got stuck in the US. The economies are in a different position. As I mentioned before, the fiscal position is completely different, and we think that will support inflation still coming back to target in Australia. So excess savings were built up during COVID, but they're being worked down now. You can see in green there, that's other savings. That's, savings in excess of putting money into your mortgage. They're coming down quite quickly. We expect the excess savings to be diminished by the end of this year. But what's really interesting is actually the excess mortgage repayments, that's offset and redraw accounts, continue to rise. And so what that means is people are cutting back on spending, but they're not cutting back yet on putting more money into their mortgage. So clearly, with higher interest rates, people are taking advantage of the benefit they get from paying down interest quicker, and they're still keen to put money in their offset and redraw accounts. And we think that might be, that might continue, and the flow through from the income tax cuts might not flow straight into the economy, and might be saved a little bit more than normal given the current, uncertainty around the economy. Interestingly, in the second chart there, you can see internal CBA data that shows there's a bit of a dichotomy between how the demographics are faring. Younger demographics much more likely to be renters or, have just got their new house and experience interest rate rises with a very big mortgage. They're more leveraged, basically. They're much more likely to be spending less and saving less. So spending less in red there, that's much lower for younger cohorts, and they're also saving less, whereas older cohorts are much more likely to have paid off their mortgage, much more likely to have money in the bank that they're receiving deposits from, and so they're spending more and saving more. So a bit of a dichotomy in the demographics, which has been interesting. So what's been the effect on this on the economy? Well, you can see economic growth has slowed quite a lot. The annual rate of GDP growth is now sitting at 1.5%, and the quarterly growth rate is at 0.2%. And then you can see the second chart there, that is just showing, the last 5 quarters of GDP data, and you can see a nice sequential decrease in the rate of growth as these rate rises have flown through the system. We've still got, aggregate demand growing up the top in blue. That's the entire economy still growing. But then we've got, GDP per capita has been falling for the last 4 quarters. So again, that represents, the pie's getting bigger, but everyone's slice of the pie is getting a little bit smaller, and kind of explains why some people out there in the economy are feeling the pinch. So why is the economy slowed? It generally slows when the consumer is weak, and that's what we've had. You can see here, it's been a wild ride on consumption growth in the last couple of years with the pandemic, but you can see currently household spending growth in volumes terms is just 0.1% higher over the year. That's well below trend growth of closer to 3%, and just represents, a lot, households pulling back on their spending. And these charts kind of explain, well, where are they putting their spending and where are they not? You can see the first chart there, that's the same chart that was there before, except it breaks it down into discretionary and essential spend. You can see coming out of the pandemic that, that peak before it started to settle down, it's a sea of blue, right? Like that's discretionary spending. That's people going out and spending money on the things they couldn't spend in during COVID. And they, had a lot of savings buffers. There was a lot of fiscal stimulus during that period. So people had a lot of money. They went out and they spent a lot. And they spent on mostly discretionary goods and services. But you can see that came off quite quickly. And now we're at a point where the blue bars at the end there, discretionary spend, is actually detracting from overall consumer spending. The only thing keeping consumer spending growing very slowly is that people are spending more on essentials. So the things we don't want to be spending money on, we're spending more on, the fun stuff where we're not spending as much on as people pull back. And then this second chart here is just showing, ignoring the purchase of vehicles up the top, that's, due to unclogging supply chains and a lot of cars coming into the country. But then we go down that list. This is, consumer spending over the year. We're spending more on transport services, health, communications, education, insurance, rent, food, things that we can't really avoid spending money on. We don't really want to be spending more money on those sort of things. And then down the bottom, if we look at some of the ones that we're spending less of over the year, you've got things like recreation and culture, other goods and services, clothing and footwear, eating out at restaurants, household goods, all those things we're spending less on over the year. And, that just really highlights that, people are pulling back on the discretionary spend, and that's flowing through the rest of the economy. The Household Spending Insights is our report that we release, and this is just broadly showing a very, very similar pattern. Note that this is nominal dollars, not real, so it includes the impact of inflation. And you can see, again, growth has slowed quite a lot, and you've got in the second chart there a really similar sort of pattern there with, in education, insurance, utilities, health, transport, all the things we're spending more money on. And then, hospitality, household goods down the bottom that we're spending not quite as much money on. Interestingly, also, we get data on where people in the country are spending money. And right now we're seeing, the weakest spending outcomes are occurring in the big population centers, Sydney, Melbourne, where people are more highly leveraged, housing is more expensive. And that's where we're seeing spending actually the weakest. Where we're seeing it the strongest is those areas that aren't as affected by these sorts of things. WA, regional areas, South Australian regional areas, spending there is holding up a lot better, broadly because, house prices are a lot lower. So I kind of touched on the growth story, 1.5% over the last year, below trend, but almost no growth in household consumption, and household consumption is the biggest part of the economy. So what's been driving the growth? Well, primarily it's been public demand, which is government spending, and business investment. So starting with public demand, and this, has been, confirmed by the budget this week, government's still spending a lot of money. The government, the public sector is growing quicker than GDP and has been for quite some time. We saw, a big increase in, public consumption during COVID, due to just all of the money that they put into the economy. But I'll focus on, the blue line in that first chart, public investment, which has grown rapidly over the last decade or so. And this is broadly a good thing. It represents governments investing in primarily things like infrastructure, and especially that's not the federal government generally, that's the state governments, and especially in, Sydney and Melbourne. Really massive infrastructure projects have been funded over the last 10 years. A lot of that's been government money. And so that's, been a source of growth and has been one of the reasons why the government's been growing as a share of the economy, but is important for future productivity and increasing the productive capacity of the economy. It remains firm, the outlook for all this spending. You can see in the second chart there, the state capex plans. This will be slightly different after the Victorian budget recently, but this was last year's numbers, and you can see here out till 24-25, which is the coming financial year, was growing and then starting to ease, but still quite a lot of public capex going on. You've got things like, the Sydney Metro in Sydney still being built, so a fair bit of government spending going into those sort of things at the moment. And then business investment has also been firm through 2023. Both mining and non-mining investment have picked up from the start of the pandemic, which is a really, positive sign. Hopefully the Future Made in Australia policies, if they come to fruition and work the way as intended, will boost business investment in key industries. But that's more of a medium, longer term policy. Currently, we're seeing, still firm business intentions, although they have eased a little bit. You can see in the second chart there, after a bit of a spike in mining and non-mining business investment, we've seen, those intentions in the dashed lines there come off a little bit, but still broadly been a positive news story, the business investment side. And then finally, the green transition, as I mentioned again, is becoming a focus. I've just put the utilities capex or private investment intentions there. That's, rewiring the nation, transmission lines and the like. You can see the long-term expectations there for capex have really, really started to get going, which should be a source of business investment in the medium term. So another key theme has been population growth, and we've been hearing more about this of late. We saw a really rapid rise in population growth after the opening of the borders post-COVID. You can see the majority of the population growth has been driven by net overseas migration, and the majority of that has been driven by international students. So one of the key reasons why, it's been an important theme has been, just the magnitude of the increase in population has been really, really strong. But also it's just been a lot stronger than the government had expected. So you can see in the second chart there, the October 2022 budget expected, net overseas migration to get a little over 2,000 at about now. It's currently at over 500,000. So just a lot more people in the country than, economists were expecting, than anyone was expecting. And that's placed some pressure on parts of the economy and has provided, a boost to aggregate demand overall. And this is, again, the theme I was touching on before. Population growth has really cushioned, the per capita recession that we've had. You can see in aggregate, the economy remains growing in blue there, but per capita really leveled off and coming down. And we think that's been a key reason why, and this is probably relevant to this group a little bit, why businesses, weathered the cycle okay. Businesses, a lot of them are not super concerned about perhaps, people spending less per capita, if that can be, if that gap can be closed by more people in the country, more aggregate demand. And you can see here, business conditions in blue in the second chart from the NAB Business Survey has eased, which makes sense in a slowing economy, but hasn't nearly eased as much as, consumer sentiment has. And to us, that is reflective of that per capita versus aggregate story. Individually, we're feeling, really under the pump, but, the aggregate economy has continued to grow in part due to this strong population growth. So one of the downsides, I suppose, of the strong population growth is it has placed significant pressure on rental markets. You can see the first chart there is the rental vacancy rate. For context, a healthy market is considered, around that 3%, pretty much all around the country now. That it's under that level, especially in the smaller capitals, which have seen stronger population growth. In Sydney, we're about, the 8 capital city level, about 1.5. So really, really tight rental markets. And when there's tight rental markets, rents will begin to increase. And that's what this second chart is a little bit more difficult to explain. But what this is basically trying to show in the blue line in that chart is basically how the mix between the supply of housing coming online and the population growth is faring. And then the red line is, the growth in rent. So a higher blue line means that there's population growth is outstripping supply and vice versa. And you can see rents has a really, really close relationship with this. What this means is for rents to really ease, we need, more housing to come online or population growth to ease. And we would expect population growth to ease this year. It can't stay at the levels it currently is. The government's trying to bring it down. So we'd expect some easing of rental conditions this year. So touching on where it's affected, industries the most, locations in Australia the most. It's really been where the population growth has been strongest. This chart just shows the really, pretty tight relationship between where population growth down the bottom has been strongest since prior to COVID. Primarily, that's a Brisbane and Perth story. That's where it's been strongest, and that's where we've seen the most rapid increase in rents over that period. So we've got tight rental markets, as I mentioned. Unfortunately, we're not building many homes. We're not approving many homes at the moment. There's a lot of pressure on the construction industry. Interest rates are high. There's a lot of capacity constraints. So people are a bit wary about, building new homes. You can see in the first chart there, building approvals per capita is the lowest it's been in the history of the series. This comes after a bit of a spike during the pandemic due to the home builder policy primarily. And then if we go to the second chart there, you can see the spike in red there is the spike in commencements that we saw of houses being started. And that was, again, spurred by the home builder policy. But interestingly, what we haven't seen is that blue line pick up to match the red line. And normally we'd expect that to happen. It normally follows it quite closely. But currently, we've seen that disconnect mostly due to, as I said, these issues in the construction sector, constraints, profitability problems. So there's a lot of houses out there that are currently being built that aren't, that will come online at some point. In other words, the pipeline of housing to come online is still quite high, but there's uncertainty around when this housing will actually come online, or if it will be completed, or how many projects have been shelved and the like. And so, yeah, a lot of uncertainty in the housing market. It's not going to be fixed in the near term, and broadly it'll stay constrained. This is contributing to housing prices continuing to rise. You can see, really, it's a bit of a two-speed story at the moment with Adelaide, Brisbane, and Perth still growing quite strongly, especially Perth has been incredibly strong. Melbourne has been flat for quite a while, and Sydney is growing only modestly. We think that's just, broadly underlying demand for housing remains robust, housing supply remains constrained, and people are looking for, a little bit more value with their housing and going for the more the more lower price places like Perth and Adelaide. So if we look at affordability, it's definitely deteriorated, especially in Sydney. It is a lot worse than other parts of the country. The recent spike in Sydney has taken, in our analysis, housing to become, broadly unaffordable for 2 full-time income earners earning the average income. So that's the way we sort of look at housing affordability. Is it's probably most likely if you're buying a house, it'll be with 2 incomes. And if you're earning the full-time average wage in Sydney, then housing is broadly unaffordable. The other capital cities aren't quite as bad. We've got Melbourne still a little bit above the other capitals, but we'd expect that to actually shift when we update these numbers because Brisbane, for example, housing is broadly at a median level now more expensive than Melbourne. So we need to update those numbers. But clearly, Sydney especially facing some affordability constraints. We expect house prices to continue to rise this year. We had 5% forecast, but that looks like it's going to be higher than that. But yeah, there's nothing to stop housing prices rising in the near term, especially if interest rates come through as we expect. We expect house prices to continue to rise. So having a look at insolvencies relevant to this group, you can see they picked up quite a bit, and it's clearly a sign of a slowing economy, and some of those businesses that maybe weren't profitable, that were supported by stimulus through COVID, are starting to become insolvent. The pickup is concerning. I think like the rate of change of insolvencies is quite strong at the moment, but clearly there was a big drop in COVID. A lot of businesses were supported, as I said, by those fiscal measures, and so the trend of insolvencies remains well below the trend. But any like rapid pickup in insolvencies, I think, is something to watch, even despite being below the trend. So the industries, the main culprits, as usual, really are construction. I've touched on the issues in the construction sector, and accommodation, hospitality, always quite a high level of insolvencies, and really probably being hit right now by the contraction in discretionary consumer spending. So quickly touching on before I finish, the labour market remains tight but loosened a little bit this week. You can see in the first chart there, down the bottom, the unemployment rate has picked up, but it remains very low by historical standards. Clearly, the labour market remains quite tight. You can see the second chart there's a good one to kind of show how the level of unemployed people out there relates to the amount of job ads available. So you can see from a very low point, we've kind of gone up now to around 2.4. That's just representative of how many people are out there per vacant job. It's a lot higher than that in major economic dislocations. But any turnaround like that is clear evidence that the labour market has started to loosen. So as I said, we got an update this week. It is slowly loosening. It's clear it is slowly loosening, and all the forward-looking indicators point to that. You can see in this first chart here, the underemployment rate and unemployment rate are rising. Employment growth on trend level has picked up a little bit recently, but remains below the level required to keep the unemployment rate from rising, given the strong population growth we have. And we're also seeing hours work slow a little bit quicker than what we've seen employment slow down. That probably represents, a more flexible labour market than we used to have. More people are able to cut hours before they cut headcount. So we rattle on about the labour market loosening and us expecting it to continue to loosen. This is why all the data to us suggests that the labour market will loosen further. You can see in the first chart here, we've got a bit of a disconnect right now between GDP and employment, usually pretty well correlated. And right now we've got quite weak GDP, with employment still growing quite strongly. That gap, will close. It kind of has to close if, economics is right, and we expect it will. And then also we've got on the second chart there, various measures of labour demand. This is one from Seek, the website where you can go on and look for jobs. They've got a really rich data set on the labour market. You can see that in blue there, job advertisements have come down, and the amount of job applicants per job has really started to move higher. So that says to us, looking forward, that the labour market will continue to loosen. But as I said, it does remain tight. And well, what happens when there's a tight labour market? We get wages growth, and that's what we've had. Wages growth peaked at 4.2%. At the end of last year. But the data we got this week on Wednesday showed that wages were 0.8% higher in the quarter, 4.1% higher over the year. And it's a very slow moving series. It doesn't spike like other indicators. And that says to us that wages growth has likely peaked in Australia at 4.2% and will continue to ease. This is in line with the loosening labour market. And also, the good news is that should flow through to services inflation in time. And then the second chart there is just kind of highlighting how we think about this sort of stuff. So you can see the underutilization rate there in blue. That's the unemployment rate and the underemployment rate combined. That's come off. Again, that indicates to us that the labour market is loosening. And generally speaking, when the labour market is loosening, wages growth will ease. They've got a very good relationship. You can see wages there in red in the second chart. And with underutilization coming off the peak and coming down, we would expect wages growth to ease from here. So quickly touching on the broader view, soft landing is our base case. We don't think there'll be a recession in Australia. We think the next move in rates is down despite the expansionary budget. Cost of living pressure will remain acute this year, but there are some circuit breakers that will help provide relief in the second half of this year and start to boost growth a little bit. And those circuit breakers are primarily positive real wages growth and improvement in real household disposable incomes, the tax cuts, as I mentioned, from July 1, and then the RBA easing in November in our view. So the RBA call, 25 basis points this year, 100 basis points next year, taking the cash rate down to 3.1%. We think that'll be a level that will be able to support the economy as the economy slows and stop that unemployment rate from rising too quickly. The RBA has made a big song and dance about really being keen on keeping that unemployment rate from rising too far. They really want to preserve as many of the gains as they can from this cycle. And so we think they'll be really alert to stopping the unemployment rate from rising by providing a little bit more support for the economy, provided, of course, that inflation evolves as we expect. So you can see in the second chart, we've got the cash rate forecast. In red, you've got our forecast. In green, you've got the consensus of economists on Bloomberg forecast. So, we're broadly in line with most economists. The money markets, however, are a bit more pessimistic on rate cuts. They're still pricing a slight risk of a hike in coming months, and that is the clear risk in the near term. If inflation prints high in the next print, that is the risk. But then after that, they're pricing cuts, a bit later. But yeah, near-term risk hike, we don't think it'll come to that. We think, the RBA will be keen to support the economy at the back end of the year with some cuts. But yeah, that's it. I'll leave it there and go to questions if any have come through.
Thank you, Harry. That was very comprehensive. We've had a couple of questions come through. I'll just run through them. Yep. I think you sort of already covered this, but do you think the new federal budget will further fuel inflation like its detractors say it will?
Yeah. I mean, that's the big argument at the moment, right? Is, will it add to inflation? Look, it's going to detract from headline inflation. It will mechanically reduce headline inflation. The more nuanced question then is, will these subsidies and extra spending flow through to other parts of the economy and provide more inflationary pressure than it takes off? I think it's just too uncertain to say at this point. I think from our point of view, we'd say on balance, the budget is expansionary and will be slightly inflationary in some areas. But until we see how consumers respond to the increased stimulus, or how other parts of the inflation basket rebalance over time, it's really hard to say whether it will add to inflation or it will take away from inflation. I think from a first principles perspective, clearly it's more stimulatory than we expected, but we don't think it'll change the dial that much. And if you think about the context of some of those other countries that I mentioned that are running these huge deficits, it's not quite as big as some other countries.
Thank you.
Sorry.
No, you're right. Comment here that they've been seeing various banks and other large companies offloading large numbers of employees, and observed that is similar to what happened in the lead up to the GFC. And is that anything that sort of might be an indicator of where we're heading?
No, I wouldn't say so. I think, businesses typically will start reducing employment when the economy slows and the outlook sours, and that's what we've seen in some industries. I think there's also, after a period of strong profits and a period of where they think things are going to slow down, it makes sense. It hasn't really impacted the broader labour market at all. As I said, the labour market remains strong, really, really strong, really. Again, we expect it to weaken, but it remains strong right now. And most of the job losses that we are seeing are in those sort of industries, but they're kind of smaller industries broadly. The really big drivers of employment growth got recently and going forward are on the care economy, education, health, aged care, things like that. So that's what's really driving the overall labour market story at the moment. I wouldn't be too concerned about a few big companies and a few big banks cutting a few thousand jobs. It's just not enough to move the needle.
Thank you. So how can you be predicting inflation is going to go down when we've got the big tax cuts coming through? There's going to be a whole bunch of money put into households' pockets.
Well, the tax cuts will clearly flow through into growth there, but it remains to be seen, how much people spend of the tax cuts. So there's also, it's not like everyone gets $4,000 a lump sum in a tax cut on the 1st of July. It's spread over the year. Clearly, it'll add to growth, but currently, if you think about how it flows through to consumers, what are they going to be spending more money on? They might go out and spend a little bit more on discretionary goods and services, but that inflation is already broadly under control. That's not really what we're worried about. And if after in the next 6 to 12 months, there's clearly a possibility that the tax cuts flow through and add a little bit to inflation in that part of the basket. But then by that time, we'd expect some of those other parts of the basket to be coming down. So look, inflation. Trend is your friend. Inflation is coming down. It's the last mile, as I said, has been tricky in some areas. But if you look at the fundamentals, the economy has slowed a lot, and some of these idiosyncratic factors that are keeping inflation high, as I mentioned, like insurance, rents, and home building, they're tough, but we think they'll come down over time. And they're not really affected by tax cuts or anything like that. So look, we think the trend is broadly down and we'll get back to target at some point at the end of the year. But yeah, obviously it's a clear risk. The fiscal policy is our main focus in terms of risk. And if that flows through and people start spending heaps, inflation, takes off, it's clearly a possibility, but not our base case.
Thanks. Is there any reason why the Northern Territory and Darwin aren't in any of your charts?
It's a question we get a lot in terms of why various areas in the charts. It's essentially just because it just gets a bit too busy a lot of the time. And it's just, it's not a massive part of the economy. If, often we'll do, if people approach us to do specific presentations about specific areas, we're always happy to do that. But when we're talking about the whole of the Australian economy, it's difficult. But yeah, that's generally why, and we run out of colours to use, and it just gets a little bit messy.
Yeah. What is the impact of the Fed rates, so US rates, on the Australian market, and do they have an impact on like Australian bank funding, and thus flow through to Australian bank interest rates?
This is probably stepping a little bit out of my wheelhouse, but mostly the way it affects in terms of if we're thinking about the rates market, like the interest rates markets out there, we'll just follow broadly whatever the US does at all times because they're, the behemoth of the world market. Often all economies will sort of follow what's happening in the US to a certain extent. But in terms of the mortgage, the rate that we pay on our mortgage is not affected by what happens in the US, unless you argue, of course, that if the US interest rates remain high and that affects how far we can take Australian interest rates down in terms of interest rate differentials, which has an impact on things like the exchange rate, etc. If you make the argument there that, if the US is really high, we're not able to ease rates, then obviously that affects your mortgage market. But we don't, the Aussie banks aren't super reliant on US funding or anything for our mortgage market. It's, a lot of it's deposits actually in Australia.
Yep. Do you have any sort of projections on productivity and how that will impact the outlook going forward?
Yeah, so productivity is a really difficult one. We kind of it's so, in terms of improving productivity, that's kind of the job of microeconomists to think about that. We're more macro, we think about the broader economy, but clearly productivity is important for growth long term. Really improving productivity is the only way to increase living standards over time. And currently it's weak. I didn't have a chart in there on productivity actually, but what you would see if you saw the productivity chart is a big spike in COVID and then a big fall in COVID and after COVID. And now it's kind of like just a little bit below what the trend of the pre-COVID productivity was. And at this stage, I would kind of say ignore everything that happened in the last 3 years in terms of productivity and focus on what was happening pre-COVID, which was flat productivity and not much productivity at all. And that seems to be the broader trend rather than this massive drop-off in productivity that we've had over the last year, which just doesn't seem, plausible really. If you think about, have we become 3% less productive over it? It's just, that's not likely. It's more that there's difficulty in how it's measured. And COVID just threw it all out with, a massive rise in employment before the capital stock could catch up. And so to get to my point, I would focus on the pre-COVID era. Productivity was really poor, and it seems like we're still on that trajectory. And the implication there is if we don't get a way to see productivity moving up, then that is inflationary. It makes it very difficult for inflation to come down and stay stably in the target. And I think, broadly speaking, if we think about from a macro economist point of view, how to improve productivity, what's key is stimulating business investment, making sure that businesses are incentivized to invest in their business. We've obviously got the Future Made in Australia policy coming up. I mean, that's, a longer term focus. We don't know how it will affect it in the near term. And then, things like we need some tax reform on key things like stamp duty and the like. These are sort of the things that could improve productivity. But broadly, it remains weak. It's a story all over the world as well. As we shift to more services-based economies, it's very difficult to increase productivity for a nurse or something as opposed to increasing productivity in a factory and the like. So it's a challenge. The productivity challenge is one of the biggest challenges we have. But it's not my area of expertise. We leave that to the Productivity Commission and Danielle Wood now to advise us on all that sort of stuff. And we try and forecast, what GDP is going to be next quarter rather than in 10 years or something. But sorry if it doesn't answer your question. But
No, all good. We'll do one last question. We've got heaps, but we're running out of time. So one last one. How do you factor in external factors? So like, geopolitical risk, fuel costs, those kind of things into your models when you're predicting out what's going to happen to Australia?
So to be honest, they won't factor in our models per se. Like we have our models that are based on various indicators, and we just have to think about the risks with the geopolitics and the like. We can't read the future. We don't know what if a war will break out in the Middle East or and an oil shock happens. We can't just throw that in a forecast and say this is what we think will happen. We just have to frame our forecast through this is the base case. If this is the risk if something happens. So for example, our base case is for inflation to continue to come down based on our models and what we're thinking. But there's obviously a risk that doesn't come to fruition if there's an oil shock due to some geopolitical event. So we're getting asked about that a lot at the moment. We're also getting asked a lot about Donald Trump coming back in and the effect of that on the Australian economy, which is an interesting one as well. I think he's very keen on slapping some tariffs on various countries. And again, we just have to frame that, that if that's a risk, if it happens, we'll address it. But right now we've got our base case that we have to stick to.
Yep, makes sense. All right, well, that's all we have time for today. Thank you, Harry, for taking the time to share your expertise with everyone here. And thank you, everyone who attended, for joining us today. Have a wonderful day, everybody.
No worries. Thanks, Brendan. Thanks, everyone. As I said, send me a question if anyone has any. Always happy to answer. All right. Bye.
Thanks, Harry.